But first, coming up here, Fed Chair Jerome Powell is speaking right now before the House Banking Committee. We'll be looking for headlines here as they come in, but we know yesterday some of the key drivers of his commentary and therefore the market movements were some of his comments about inflation cooling, sounding potentially a little bit more dovish for the market moving forward. Let's take a listen to what he had to say.
If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation.
But how much emphasis should markets be putting on the Fed's path forward? Joining us now to discuss this, we've got John Petrides, a portfolio manager from Tocqueville Asset Management. We've also got Kevin Flanagan, head of fixed income strategy at WisdomTree. Thank you both for joining us, and thank you for being in studio. We appreciate it. I do want to start with you because you just heard that soundbite from Fed Chair Jerome Powell. Did any of his commentary move the needle for you at all? Was it more of the same?
Well, I think the Fed has been very cautious of not wanting to repeat 1970s Fed policy mistakes of stop and go, right? So clearly there's more conviction, and I think a lead up to the Jackson Hole meeting in August, where the Fed will probably start talking about cutting 25 basis points or something along those lines. So that's a really good sign, I think, from that perspective. And those that are still convinced the Fed is going to raise rates, that's off the table for at least the next year.
And Kevin, when it comes to what has really been moving the bond market, obviously lots of focus here on inflation and exactly what we have heard Jerome Powell say, and kind of the change in tune almost, just in terms of also a little bit of worry about what's been going on within the labor market. But Kevin, I'm curious from your perspective, what's been the biggest driver of yields when it comes to Fed and commentary, and really what investors should be focused on?
Well, I think your point is very well taken, that they're back to the dual mandate. The whole focus had been inflation, inflation, inflation. And I think Powell pretty much laid it out yesterday that the risks are now balanced and that he is seeing some cooling in activity in the labor markets. I mean, jobless claims are still, though, 100,000 below where they normally are before a recession, even the pre-COVID 40-year average. So it's not as if it's weak or falling off the cliff. And I think that's what Powell's trying to do, is to strike a balance here with respect to policy going forward. To the point, once again, being well taken, the Fed does not want to make a mistake here, one way or the other, right? They don't want to be on hold too long, but they don't want to cut rates too soon. So it is kind of a tightrope that Powell and company are walking. And that's what the bond market's trying to figure out, and why we're going to continue to see volatility. A highly data-dependent Fed, highly data-dependent bond market, that equals volatility.
Kevin, do you think we're going to push back up against that 4 or 5 level in the 10-year?
Yeah, you know, I would say 4.5 is kind of an equilibrium level, plus or minus, say, 20, 30 basis points. So 420 to 470. Some people might say, hey, you can drive a truck through that. But back to my point before, that's where we're at this stage of the game. So I think if the numbers continue to come in as they have, you open the door for a September rate cut. But remember, this isn't going to be like the rate hike cycle. This isn't going to be, every meeting. It's going to be a little bit more choppy, 25 here, 25 there.